Hello everyone, welcome to Anu's classroom. In this video, we are talking about the legal and regulatory framework for financing and investments of businesses. This is the fourth block. This is the fourth block of MMPC 13. From this chapter or from this block also, we have had at least one question in every term and examination. Sometimes it has come to up to two questions. This block consists of three units. Okay, the first unit deals with the banking related regulations and things like that. Second unit deals with the foreign exchange management and its regulations. The third unit talks about insolvency and bankruptcy. What insolvency is, what is bankruptcy, what are the processes involved when you file for bankruptcy, how the whole process works, like that. So the entire framework, not the entire framework, but the crucial frameworks that are related to the what you can say financing as well as investments that take place in the business. So let's get started. Make sure you stick till the end of this video so that you will not miss at least the major topics which are covered in this unit. All right, so let's get started. So the first unit in this block talks about the evolution of banking regulation. So what do you understand by banks? We all have interacted with banks, right? We all have GPay, we all have a bank account. I don't think there is any much significant percentage of population right now in India who does not hold a bank account after our Prime Minister has become Modi, right? So everything and anything goes through banks. So what exactly are banks? What do you understand by banks? How do they function? Okay, so basically what a bank does is it accepts money from people, from public, for safekeeping, right? We go and deposit money into the bank, and when we give bank money and we say that, see, my account has this much money, it is treated as legal tender, equivalent to actually holding money in your hand. Why? Because it is as good as there, right? You can liquidate it very easily, especially if it is a savings account. All you need is either a check or a debit card. Now, right now, even a UPI ID is enough, right? So that is how banks get money. Now, banks are holding all this money, right? And for safekeeping of this money with the bank, and for accepting its and for what you can say providing us the services like internet banking, ATM card facility, check withdrawals, all those things, what happens is bank will also uh, take some fees and charges from us, right? So we have to give the bank a nominal amount of money every year for its annual charges so that it can continue providing us with services, right? We are having a lot of facilities because we are using a particular bank's services. So that is another way of banks making money. But now, what will the banks do? So the banks also in return also gives us interest for the money which it is holding, right? It is in India, especially if you talk about American banks and all, it is as good as 0% interest, like very very frugal interest they will give you. For that also they will take charges, so in effect you won't get anything for putting your money in the bank. But it is not like that in India, right? So India, even savings account will come with at least a minimum of 4% interest for the money that is there in our savings account. So how does the bank give us this money? From where does the bank get the money to give us, right? Whether I am holding 1 lakh rupees in my account or 10,000 rupees in my account, the annual maintenance fee that I provide might be almost similar, like 500 rupees or something like that for SBI, similarly something like that for HDFC and all. But the amount of rupees that they give me as interest will depend upon the actual amount of money that I've deposited with them. So how do these banks get the money so that they can give us? For that, what the bank does, it takes the money from us and it will give it to the people who want money, right? It will give loans. That is how it works. So why I told all the story, which I know that you already know how banks function, is, see, banks are giving our money to lenders, right? But the money which the bank is lending actually is our money. So anytime we go and ask the bank money, it is liable to pay us back. But the loan which is taken from the bank by a business owner or by somebody, even its customers, to get, maybe to take buy a what you can say, buy a flat or buy a house, maybe buy a property, buy a car, whatever it is, start a business, that money I have to pay back with interest, that is there. But I need not, it's not like the bank comes one fine morning, the bank comes and asks me, hey, I want 10,000 rupees. The next day he comes, okay, I want 20,000 more rupees. You have to give me because you took the loan. That is not how it works, right? But for us, if we have deposited the money, I can go and say, hey, give me 500 rupees today. Tomorrow I'll maybe again go and say, in the morning I want 10,000 rupees. In the evening I can again go and say, give me 30,000 rupees. The bank is liable to pay me if I have that balance in my account, right? So the duration for which the money is locked is actually quite different in the case of both these types of customers. Like, so that difference in the duration, right? One is, so it's like short term assets and long term liabilities, right? Did I say it opposite? Yeah, it has short term liabilities and long term assets. So what happens is the banking business becomes actually quite risky. So there is a very good chance that at any given point of time, if there is a bank run, the bank would collapse. No matter how good the bank is or how good its service is, it is a very risky business. Similarly, it is not just that in one place there is only one bank. There are multiple banks. I might have an account in SBI. You guys might be having an account in Axis or ICIC or HDFC. So, or even I might have accounts in multiple various other banks, right? Not just one bank. We don't just hold account in just one bank. And even in one bank, we don't hold just one account. Sometimes we have FD, sometimes we have savings, sometimes we have also a current account. Maybe we have multiple savings accounts, like that, right? So we have multiple accounts also. So what will happen? Like, suppose I am buying something from you. Okay, you are a merchant and I've come and I've bought something from you and I'm giving you a check. So I will have only the check of SBI, which is my bank. You might not have an account in SBI. You might have it in HDFC. So what will you do? I will give you my SBI's check. You will go and present it to HDFC. HDFC Bank will send this check to SBI for clearance. And SBI will check, okay, whether there is a proper balance in this account, and then accordingly, if there are no locks or anything that, I mean, there are no locks or any kind of blocks in the account, it will give the money to HDFC, and then HDFC will credit into your account, and that is how you will get the money in your account, right? So that is called the check clearance system. So earlier it used to take, if you, I don't know whether you guys are familiar, I'm not familiar, but I've heard it from my parents that if you present a check, it used to take at least a week or even 3 or 4 days for the check to get passed and the money to be received. Even now, I guess there is at least a delay of 1 or 2 days. Even now, right? 1 day at least is there for checks. So, but how this wait time has reduced is because of such a banking regulation that clearance houses were set up. So in every bank will come into that clearance house, and they will exchange the checks, and only the net difference, like if I am liable to pay, suppose say I am HDFC and you are SBI or you are Axis Bank. Okay, I have Axis Bank's 1 lakh worth of checks. You have maybe HDFC's 2 lakh worth of checks. So in effect, the net difference that is payable is HDFC has to give you 1 more lakh. So only that 1 extra lakh I need to give. So like that system was set up, that clearing houses. So all those things, and then again, if there is any, what you can say, any grievances, there has to be a platform where those can be addressed. So all those things came into being with the evolution of banking revolution. So these banking regulation. So these were the conditions which necessitated that a banking regulation has to set up. So mainly the objectives are to facilitate the payment instructions between banks, and because of this fragile nature of this banking system, there should be some authority, a lender to all banks, okay, which can help the banks and support them, so that in the event of an unlikely event of a bank run, the bank doesn't collapse, because nobody wants to invest in a potentially failing business, right? Not even the banks. So that's why. So some of the regulations in relation to this chartering or licensing include the Banking Regulations Act, regulations in relation to bank management, regulations for ensuring the liquidity and healthy lending practices, reporting requirements, inspections, audit, penal powers, like if the bank defaults, then what should we do? If there are multiple violations of law, then what should be done? So such things, those are called penal powers. So all these things are given again in detail in our textbook. So let us go one by one. First is the Banking Regulations Act. So this Banking Regulations Act, or BRA, gave RBI a very wide amplitude in the granting of a license to banks. So there are mainly commercial banks. They are categorized into three: payment banks, small finance banks, and fully fledged commercial banks. So if you are opening a bank as a payment bank, then you are not allowed to give out any loan. If you are a small finance bank, like we have ESAF, right? In Kerala we have ESAF. I think there are ESOF branches in other parts of India as well. So ESOF is a small finance bank. Okay, so those kind of banks can give loan up to around like say 25 lakhs and all. This upper cap can be modified by RBI. Okay, so um, this payment banks and small finance banks and any other category bank, okay, which is fully fledged like SBI, HDFC and all, they can give loans more than 25 lakhs obviously. Okay, and they have more privileges and they have more services also. So this when you talk about this payment banks and small finance banks, their risk is relatively smaller, like because of this cap and all. And payment banks, definitely you cannot pay loans, so the chances of collapsing becomes a little bit lesser than when you talk about fully fledged banks. So licensing regulations also for these payment banks or small finance banks are much more lenient compared to, or much more easier compared to these fully fledged banks. So also, if you have to license a company and operate it as a bank, then you have to look at its capital. So it again, this banking company's capital has initial capital as well as the capital in relation to the business. So in BRA, again, initial capital and the amounts that are mentioned, all those things have come into. But right now what happens is RBI will give out the minimum capital to the bank that is required to have, and also it will lay out the capital which a bank needs to have in accordance with the size of its business and the risk profile of its loan assets. Similarly, in the case when it comes to bank management, that is again, in this also there are two aspects. One is who controls the bank, okay, that is its shareholding composition, and how much degree of control these shareholding body can exercise on the bank. That is also said in the Banking Regulations Act. Similarly, the quality of management and its conduct is also mentioned in the Banking Regulations Act. Why? Because it is very important for banking companies, depositors, as to the distribution of this shareholding and the extent of control that the dominant group of shareholders can exercise over the bank. Right? If there is a director and he is holding maybe large number of shares in something else, then naturally as depositors we might feel that our funds might go over there, and if that business fails then our money would be lost, right? Things like that could happen. So in order to prevent that, there are a lot of regulations set forth in the Banking Regulations Act to ensure that there is very quality bank managing done. Okay, so similarly, a banking company is forbidden to lend to any director or any person the director may be interested in. The bank may not remit any debit which is due from a director or any person in whom the director may be interested in without the prior permission of the RBI. A person has, if they have to be the director, then they must not be a proprietor of any business concern. All employees of the bank are deemed to be public servants, so they all come under the Prevention of Corruption, okay, Act. So if they are found to employ in any kind of malpractices including corruption, they can be penalized accordingly. Similarly, RBI will have or has the power to remove any managerial person or officer or employee in the interest of the depositors or for securing proper management. They can even appoint its own nominee to the post. Okay, similarly, it may also appoint additional directors on the board or administrators to manage the affairs of the banking company. To ensure liquidity and there is healthy lending practices, there are again certain regulations set forth by RBI. Like banks can only do business that is permitted under Section 6(1) of Banking Regulations Act in addition to banking business. And what it cannot do directly, it cannot do indirectly also. The bank is forbidden to trade in goods and hold immovable property for a period of more than 7 years. And that is how this what you can say, when you take a loan, the bank cannot hold for an indefinite amount of time and all. The guidelines and directives of RBI will always be binding on all the banks for ensuring liquidity again and to prevent sudden panic causing search for the need to liquidity. Any act done by any person that might undermine the confidence of depositors in a banking company is deemed to be punishable under law, and depositors are automatically given a deposit insurance to the extent of up to rupees 5 lakh. Every scheduled bank has to maintain a deposit of a certain percentage with RBI in order to ensure liquidity in case of a sudden demand. Similarly, they themselves have to keep a cash reserve, right? And then there is the repo, which is given repo rates, reverse repo rates and all. If you have heard any budget finance budgets, you might come across this thing. RBI's governor says all these things, right? We have increased the repo rate, we have decreased the reverse repo rate, and things like that. Okay, so these are all what you can say facilities provided by the banker of banks, RBI. That is the apex bank which supports, or the lender to all banks kind of support system which is there in place in our country in order to make sure that if it is avoidable, banks should not be run over. Okay, then for reporting requirements, inspections, audits and all, there is a regulatory reporting. We need statutory audits by trusted auditors. There could be inspections. Banks will have to share its credit information with the RBI. An RBI approved auditor will what you can say do the bank's audits from time to time and submit those reports to RBI. Similarly, banks are supposed to what you can say give certain reports every month on, I guess, the last Friday or something like that. Yeah, the last Friday of every month, every bank has to submit the what you can say what is the demand, what is the liabilities, how much is the ratio, cash reserve ratio they have, all those things, along with any other additional information. RBI asks them in a given format along with any information, additional information. So if you guys have worked with banks, or if you are a banking employee studying for any kind of bank tests, you might know all these things better than me, right? So all those things are there in order to make sure there are reporting requirements, inspections and all are met. And why this is required is because RBI is the lender to all banks, right? So they must have a proper control and awareness about the bank's dealings, day-to-day dealings, so that any kind of a trouble can be spotted early on and rectified later, right? Coming to the penal powers, we have mainly three components, that is legislative or rule making, executive and judicial. Okay, so the first level, if found that there is some problem, RBI can deny permission which can be expected from RBI, or deny the enjoyment of general permissions that are given to the sector by the regulated entity. Level 2, it can forbid the bank from doing what constitutes the core of its banking business. Third level, it may impose a fine on the bank or its officers. Or fourth level, it could go for cancelling the license of the bank itself or any of its branch. Fifth level, it could initiate winding up of the banking company. Okay, and level 6, it may penalize the shareholders without actually winding up the bank. The central government can also even acquire the banking company if it is in repeated violation of the RBI directions or affairs conducted in a detrimental manner to the interest of shareholders. Okay, so those are the banking related things. Coming to the next section, or the next unit in this block, is the Foreign Exchange Management Act, or FEMA, which has been formulated by the central government, and it came into being in June 1st of 2000, and that is the time it is initially brought into effect, but it is amended from time to time. Okay, it empowers the RBI and the central government to frame as well as pass regulations and rules that are consistent with the foreign trade policy. It facilitates external trade payments. It has provisions for both the current and capital account transactions. It ensures the maintenance of this foreign exchange market in India, and also provides a legal framework for proper management and administration of forex transactions in the country. So those are the main things. So the second unit mainly just talks about what FEMA is and what are the major aspects of FEMA. And the third unit of the block is this insolvency and bankruptcy. So what exactly is insolvency? Insolvency is when a debtor is generally unable to pay the debt as they mature, or when its liabilities exceed the value of its assets. Okay, that is, we are not able to pay back whatever loans we had taken. That is when insolvency. That is when we say we are insolvent. That is, we are not able to dissolve our assets and pay back our liabilities. Why? Because our assets are worth much less than our liabilities. Okay, so that is that is what we mean when we say its liabilities exceed the value of assets. So it is not enough. What we have with us is not enough to cover up what we owe. So at that point, something called as bankruptcy is initiated. Okay, bankruptcy is a legal proceeding that is initiated when a person or a business becomes insolvent. It helps people who can no longer pay their debts and get a fresh start by liquidating the assets to pay their debts, or maybe by creating a repayment plan. So India has this Insolvency and Bankruptcy Code, or IBC, which got enacted in 2016 for facilitating or has a collection of all the rules and regulations that are related to insolvency as well as bankruptcy. So, what is this Insolvency and Bankruptcy Act of 2016? What are its major points? Let's look at it. Okay. So, IBA, okay, Insolvency and Bankruptcy Act of 2016, it facilitates the easy revival and rehabilitation process for companies that are in financial trouble. That is, which is an insolvency. It safeguards the interest of all the stakeholders or governments, etc., of the company. It stabilizes the commercial as well as financial dealings of the company. It mitigates the corporate failures and attract investments. So that is the prime objectives, or you can say the reason behind coming up with this act, okay, to mitigate corporate failures and attract investments, ensure efficient utilization of financial resources to enhance the overall growth of the economy. And there are four pillars of this institutional infrastructure as described by IBA. Okay, that is insolvency professional, information utilities, adjudication, okay, Insolvency and Bankruptcy Board of India. See, these are the four pillars of institutional infrastructure as laid out by the IBC Act. Now, how is this corporate or even individual insolvency resolution process undertaken? So, this is the corporate insolvency resolution process. It is almost the same when it comes to the individual insolvency resolution process as well. So, this resolution process, insolvency resolution process, gets triggered when there is an occurrence of debt repayment default. Okay, so it can either be initiated by a finance creditor or an operational creditor or by this corporate debtor itself. And within 14 days of receipt of this application, okay, for insolvency resolution, which will be filed to NCLT, NCLT has to decide whether or not to accept or reject this application. Okay, once NCLT admits this application, it will grant a moratorium. It will appoint an interim resolution professional as well as cause a public announcement of this corporate insolvency resolution process. Okay, it will say that, okay, for this particular company or for this particular individual, we are starting this insolvency resolution process. Okay, and then after that, this resolution applicant, if required, he may submit a resolution plan to this resolution professional appointed by NCLT, and this resolution professional will submit this plan to the board of creditors, okay, the group of creditors. If they approve, if the creditors approve for this resolution plan, then this resolution professional will submit this resolution plan to NCLT. Okay, and once this again NCLT will scrutinize this plan and decide whether or not to accept this resolution plan. This whole process is according to IBA has to be done within 180 days of receiving the application, and maximum you can extend for 3 more months, that is for 90 days just once, that is okay. You can just extend it. If it is not over within 180 days, then you may extend to one more 90 days, you can extend it. Okay, now if this resolution plan, after it is approved, if you have any disagreements, then you can appeal to NCLAT within 30 days of approving this resolution plan. And if you are not happy with the judgment of NCLAT, you can go to the Supreme Court with the appeal. Okay, so those are the major important points that are covered in Block 4 of our business law. This is a bit of a boring topic. I know it is a boring video. I was also at loss about how to make it as lively as possible. But this is a very important topic. It is not that difficult to grasp. Okay, so I hope that you all will be able to prepare well for your term and examination. I hope this video was useful to you. If it was, then do consider subscribing and hit the notification icon so that you won't miss any updates, right? Thank you so much and all the best for your term and examination. I'll see you in the next video. Until then, bye.